Hey, welcome to Chapter 10, Cost of Capital. This whole chapter boils down to one equation. There it is. We are going to determine the weighted average cost of capital. I referred to this in the previous chapter when we talked about trying to value the firm using free cash flows, and I said the appropriate discount rate would be the weighted average cost of capital. And I said in that video, you'd have to wait and see. Chapter 10 is when we actually cover this in detail. So here we are, and the goal is to compute this weighted average cost of capital. And let's go over these terms here very quickly. And I'm going to go into detail, much more detail, each one of these components. Right here is the debt component. And this is the weight that we have invested in debt. Or the weight we have, it reflects our target capital structure. In other words, we're looking at a firm that we hope that we expect to have a certain weight in debt, a certain amount of bonds, and that's called WD. A certain amount of preferred stock is issued, that's WP, and a certain amount of common stock is issued, and that is WC here, these W's. These W's have to add to 1. The sum, sigma, means they just add to 1. Meaning, for example, maybe out of our total capital structure, when I say capital structure, let me show you quickly. Here we got a balance sheet, for example. Here you have your assets. Here you have your liabilities, which includes debt. Here you have preferred stock. Here you have common equity, right? Common stock. And so, and we have debt here. Okay, that's under your liabilities. You got this weird thing, this hybrid I talked about last video, preferred stock, which is kind of a blend between debt and common stock. Because why? Because preferred stock has characteristics of a bond. It has a fixed dividend payment, just like kind of like a fixed coupon, but it issues dividends. It pays dividends. So it's a hybrid. So, but what I'm saying here is that we have a certain percent of debt, preferred stock, and common stock that we would like to be able to fund the firm with. In other words, this debt is used, and this preferred stock is used, and this common stock is used to invest in projects and product lines and assets. That's why we borrow all this money on the right-hand side, use it to fund projects on the left-hand side. And so we're going to assume that we want, in this chapter notes here, we want 30% of our capital structure to be debt. We want 10% to be preferred stock, and we want the remainder, 60%, to be common stock. So it adds up to 1 or 100% of our. So we're accounting for everything on the right-hand side of our balance sheet. Okay, so the W's here are the weights that we have in each component. Now there's the weights, but there's also costs. So this is a weighted average cost of capital. So here's the weights, and now the costs of capital are here. This is the cost of debt. RD, think of it for now as basically the yield to maturity in your bond, adjusted for taxes. 1 minus the tax rate means, look, interest expense is tax deductible, so your cost is not the entire RD. It is 1 minus the tax rate is what you're really paying. And then there's no tax deduction for preferred stock dividends, and there's no tax deduction for, that's an R by the way, RS, for common stock. So this RP is the cost of of preferred stock in this case, which we looked at last video, and I'll show you again. It's basically the cost of capital for issuing preferred stock, and here's the cost of capital for common stock. Remember the security market line, risk-free rate plus beta times the market risk premium? That's one way to calculate the cost of equity. Okay, so basically what I'm telling you is the whole chapter boils down to this equation. It's a weighted average cost of capital. The weights add up to 1. And the weights are basically the firm's target capital structure. It hopes to maintain 30% debt, 10% preferred stock, and common stock of 60%. Okay. Now, let me give you some information about a company we're going to use an example throughout this chapter. And I need to give you the information on this company. Its tax rate is 40%, because I'm going to use this throughout, from beginning to end. I'm going to use this data. Okay. Now, so that's the tax rate, T. Then we're going to look at debt here. And we're going to consider the company's going to be looking at 15-year debt, 12% coupon. That's semi-annual. It's a semi-annual bond. So we'll say semi. Right? Non-callable. And the price of those bonds is $1,153.72. Okay. So we'll issue these bonds. There will be no flotation costs, and I'll go over what flotation costs are in a little bit. But there's no flotation costs here. We can basically assume that these bonds are issued privately. In other words, they're not sold through an investment banker to the public, but they're sold to individual companies. And so the costs to float them, meaning the costs to issue them, are zero. So we'll ignore those costs. Now, we look at preferred stock, and preferred stock has a 10% dividend. They have a par value of $100. Okay, dividends are quarterly, so that's $250. So that's $10 a year, $2.50 per quarter. It's perpetual preferred stock, meaning it lasts forever, just like a common stock in a sense. And the price sells for $111.10, which means, you know, right off the bat, that's telling you something. That is telling you that this preferred stock it's at a premium, and interest rates must be less than 10%, because this is an attractive preferred stock. It's selling above par, because 10% must be higher than the going market rate. The market rate, you know, maybe it's 8% or so. This thing's paying off a little bit more. So it sells at a premium. Now, common stock sells for, it has a price of $50 a share. The dividend just paid was $4.19. G is 5%. So you see where we're going with this? We're going to have to figure out RS through this information. And and by the way, we'll have to figure out what RP is from this information, and we'll have to figure out what RD is from this information. You see how the information's flowing here? Okay, the beta for this company is 1.2. The risk-free rate, make sure I get that right symbol, RRF, that is 7%, and the risk premium on the market, with a little M there, is 6%. Okay. Now, some additional information. There is a bond yield risk premium equal to 4%, and I'll explain that when we get to it. So this is the setup. Okay? So you might want to write this down now so you have it ready when I start going through this material. Okay? Now, there is, by the way, discussion in your textbook about these weights, and we're assuming for this discussion, as does the text assume, that it's the targets that matter. So we want to have a specific target. So no matter if we issue debt, preferred stock, or common stock, we want to issue it so when we're all said and done, we maintain these weights. If you issue debt by itself, it's going to push up this percentage, and it'll push down these percents, and then you're away from your target. So the assumption is we want to try to maintain this target. There is discussion in the text about these weights being a function of market values, and that's normally how we think about how to calculate these targets. So we're looking at the market value of the debt that the company has. So if you look at its balance sheet, it's based on historical costs, book values, but you can also look at a balance sheet that's all market value. And so you would look at the market value of debt plus the market value of preferred stock plus the market value of common stock to be your total capital that the firm has, all based on market values. Okay, let's look at the cost of debt now. So let me, it would probably be good for me to keep referring to this formula. So I'm going to write it out. And so now we're here. We're at the debt component right here. This is the preferred stock component, and this is the equity, common stock component right here. So here we are. We're focusing on that term first with the cost of debt. Okay. Now, like I said before, we need to take RD, and this is, think of this as the yield to maturity on the bond, just like we calculated previously. It's the yield to maturity on the bond, and we can calculate that yield to maturity. And we know what the tax rate is. That was given at 40%. And the yield to maturity on the bond is, look, it's a 15-year bond, right? Which means, and it's semi-annual, which means N equals 30. Remember this? We're valuing a bond now. And so N is 30. The present value of the bond is the price of the bond, and the price of the bond was $1153.72. So we put that in as an $1153.72. Put a minus sign in there, and we'll assume that the face values and the payments are positive. It'll mature at $1,000. The payments will be the 12% coupon, which is $120 divided by 2. So the payments will be 60, and those are positive. So you're paying $1153 and you're getting $1,060 back, is one way to look at it from an investor's perspective. And then you're going to hit compute I/Y, and you're going to get 5% for RD. That's on a semi-annual basis. Multiply it by 2 to get it on an annual basis. And so the interest rate on debt, the yield to maturity basically, is 10%. We want to get all these costs of capital, all the R's, on an annual basis. Okay. So therefore, our after-tax cost of debt is going to be, plug in the numbers here, it's going to be 10 times 1 minus 0.40, 6%. It's going to cost us 6% for bonds, to issue bonds. Okay. So that component's finished. Now let's look at preferred stock. Cost of preferred stock. PS, preferred stock. And so what we want is WPRP component. This component right here. WPRP. I already gave you that the target here, the target was going to be 10%. So this is 10%. Put that in decimal form. Now we have to figure out RP. And we did that last chapter where we valued preferred stock. And RP, recall, equals the dividend for preferred stock on an annual basis divided by the price of preferred stock. And the information that was given, that I gave you here, so look, preferred stock has a 10% dividend based on a par value of 100. That's 10% of 100 is $10. So that's the dividend on an annual basis. I mean, it pays quarterly, $250 a quarter, but annually it's 10. And then the price of the bond was $111.10. And so that is 0.09 or 9%. Okay. So therefore, the component. Okay, so then this is 9% right here. Okay. So now the question is, let's reflect a little bit on what we just did here. Is preferred stock more or less risky to investors than debt? And the reason why I'm asking that is, we have to be careful when we're doing this, because we're going to be looking at the balance sheet of the company, where we have assets, debt, preferred stock, and equity. And we know that we know from previous discussions that debt is the least risky of all these securities here. And so this should have the lowest after-tax cost of capital. And that turned out to be 6% after-tax cost. The preferred stock is in the middle in terms of risk. Because remember, if a company goes bankrupt, it's got to pay off its bonds first. After it pays off its employees and suppliers, it's got to pay off its bonds first. Those cash flows are least risky out of these three. Once the dividend, once those bondholders and the debt is paid off, the preferred stockholders are next in line. And so this is in the middle of the road risk, because if the company doesn't have enough to pay off its debt, then the preferred stockholders are going to be in trouble. But there could be enough cash to pay off these preferred stock, and so the interest rate is 9%, the cost of the capital we just calculated. And common stock should be even higher, and we'll determine that in a few minutes. But that should be even higher because these are the people that are holding the riskiest form of capital of the company, because if the company goes bankrupt, they get paid off, the equity holders get paid off last. They often don't get paid off at all, because when the company goes bankrupt, the debt holders may not get all their money, the preferred stockholders may not get all their money, and the equity holders usually get nothing. And so this is the most risky. So the point is that it's the most risky. There should be an increase in the cost of capital as we go, because we know that rates of return are a function of risk. So the more risk, the more returns. So this number should be higher. This number should be higher than 9%. Okay. Now, let's look at the cost of equity. Let's look at this guy. What is this cost of equity now? Common stock equity. So we want to go WCRS. This is a little more details to this one, and I'll explain. So RS now, and these R's, not just RS, but all of these R's here, this R, and this R, these costs of capital, each one of them, are marginal costs. And so what that means is, it's the marginal cost means how much is it going to cost me to issue one more dollar of debt, preferred stock, and equity, given that the ratio is 30%, 10%, and 60%. So on the margin, what is it? So that's what we're doing here. We're calculating on the margin, what would this be? And so when we look at equity, there's two ways you can deal with equity. There is the cost of equity for retained earnings, because companies have retained earnings. It's in the retained earnings, assets, liabilities, equity. It's in the equity section. So companies can fund their projects, and that's ultimately what we're doing. We're using this to value the company, and we're also going to use this weighted average cost of capital, to determine the discount rate for various projects. Then we could use some of our retained earnings in any given year to fund our projects. Or if we have a whole lot of projects in a given year, we're going to have to issue new common stock, new equity. And so we have to take into consideration that retained earnings cost less on the margin. The issue, you don't have to issue anything. You can just use from your retained earnings, you can use that to fund your projects. But if you have to issue new common stock to fund your projects because you have so many of them, the costs ramp up, because you're going to have what's called flotation costs, which I'll get to in a little bit. So when your textbook uses RS for the cost of retained earnings and uses the symbol RE for the cost of new equity, so that you're clear on that, there's two components that you have to deal with. Now, the point here is that there is a cost to retained earnings. A lot of people think, oh, you know, the company has retained earnings. It doesn't cost anything to use that money to invest in projects. And that's wrong, because there's an opportunity cost associated with retained earnings. That money could be used elsewhere with various projects. Remember the definition of opportunity cost. The cost, it's the return, in this case, the return of your next best opportunity. And so there is a cost associated with it, and that's RS. Okay. Now, and there's a cost to equity, because you know, you're going to issue this new common stock. It's going to cost you some money, and you're going to have to pay dividends on it, and so on and so forth. So it's going to cost you something. Now, there's a couple of different ways to calculate RS. So let's take RS first. There's three ways. We can use the capital asset pricing model, which we know and have seen, where RS equals RRF plus beta times the return on the market minus the risk-free rate, the market risk premium, that guy. There's the discounted cash flow method, which we saw in the previous chapter, where RS equals the dividend divided by dividend next period divided by the price today plus G, which is nothing but a rewrite of this formula. It's nothing but this formula, which is the constant dividend discount rate, where you value a stock. We just solve for RS. And so RS equals the dividend yield. That's the dividend yield right there, plus the capital gains, the growth rate in dividends forever. Okay, so that's one method, a second method, and a third method, which is pretty easy but hard to calculate, hard to get actual numbers for, is the bond yield plus risk premium. And that takes RS equals RD, basically think of that as the yield maturity on the bond, plus a risk premium that's out there, which may be a little hard to estimate, but conceptually think of, look, the return on stock equals the return from bonds plus the fact that bonds are, stock is a little more riskier. You have to add a risk premium onto it. Okay, so let's go through these approaches and actually estimate RS. So again, cost of equity. So we'll do the first method. RS equals the risk-free rate plus beta times the return on the market minus the risk-free. And the risk-free rate we assumed way back here, we assumed the risk-free rate right here was 7%. Okay? And look, so we got all this information here to calculate the cost of common stock, RS. So this will be 7. The beta was 1.2. Return on the market risk premium, they just give this combined for us, is 6%. And so it's 14.2% is the cost of equity. Ooh, boy, that's good. It's higher than everything else, which makes sense. So this, going back to this graph, this slide is 14.2. Remember, this had to be the least amount, middle, and the highest returns, because this has the highest risk. Okay. That's one way of calculating it. Let's calculate it the other way. RS equals D1 over price today plus G. And so D1, they don't give us D1. They give us D subscript 0, and they give us G. So D subscript 0, just grown, will be D1. So take the dividend today, $4.19, and grow it by 5%. G is 5%. 1.05, that's the top. The price of the stock today is 50, and the growth rate is 5% again. And we get an estimate of 13.8%. Now, holy, wait a second now. Take a look at this. I just calculated using the security market line 14.2, and now I just made this 13.8% using the discounted cash flow method. So it's not unusual to come up with different values here, because we had different assumptions basically. They were somewhat similar because we're pretty darn close. We're not that far apart. But remember, this discounted cash flow method had assumptions about growth rates in there that's not included in the security market line. So that can account for some of the differences. And there will be differences. And so what some people do is they take an average of these. So they would take an average, and the average would be 14%, for example. That's one way to do it. Okay. Now, there's one more method for the common stock. Okay, and that is the bond yield plus risk premium method, and that's where RS equals RD plus the risk premium, and this RD was 10%. Okay, that was given to us. Oh, we calculated that. We calculated that way back using the financial calculator. We calculated, there it is, 10% for the yield and maturity of the bond. And the risk premium is 4% here as given. And so the risk premium given way back here, the bond yield risk premium was 4%. Don't confuse it with this risk premium. This is the market risk premium. And this was the bond yield risk premium. Be careful that they sound the same. So this says 14%. So if you add all these up, the averages, remember we had 14.2 for the security market line, 13.8 for the discounted cash flow, and now 14%. The average of all these guys is 14%. And so we'll use the midpoint of all that, 14 for the future calculations. Okay. So now we're in a position to be able to fill in all of these numbers. Okay. We're in a position to fill in all of these numbers. The weights were given to us. This was 30%. This was 10. This is taxes was 40%. Okay, so we have that number. The cost of preferred stock is 10% weight, and I always put the weights in decimal form because the weights add up to 1. Put the returns in just a numeric form such as this, and mathematically it'll work out nicely in your calculator. You don't have to shift any decimals around in your calculator. Now RP we calculated a little while ago to be 9%. And then we took the target weight for common stock to be 60% times RS, which is 14. And so if we do the whole calculation, the weighted average cost of capital will be 11.1%. Okay? So the weighted average cost of capital, assuming that we do not issue any new common stock. In other words, yeah, you're not going to be able to read that. It says assuming that we do not issue any new common stock. In other words, we're just going to fund all of these projects using our retained earnings for this component, and then our cost of debt and our cost of preferred stock that we have outstanding. Now let's assume now that we have to issue new common stock to fund some of our projects. What will be the cost of equity, and what will the weighted average cost of capital be, assuming we have flotation costs? Now, a little bit about flotation costs. Flotation costs are the costs that it takes to issue new common stock. It's money that's, most of it goes to the investment banker, who helps companies issue new stock. Most companies have no idea how to issue common stock. They don't have the network and facilities that a big brokerage firm has. And so if you're a company, even like, for example, I worked in a bank, and for a long time, a bank holding company, which was an organization that is legally allowed to hold a bunch of banks. And so that's what a bank holding company does, is it's like a parent company that owns a bunch of banks. So we were in the business of money, borrowing and lending money constantly. But we had no idea how to issue common stock. We just hardly ever did it. We did it, it'd be a decade or more before we issued common stock. And we didn't have brokerage, we didn't have brokerage accounts. We had bank branches, but no brokerage capabilities and networks. A company like Bank of America, which has a huge brokerage business, Merrill Lynch and some of these brokerage firms, they have that network system. So they will, not only do they have the network system and the demand from investors, because they know all of the investors that might want to buy your stock, they have the expertise on devising the type of common stock that should be issued, and the prospectuses, and how to deal with the Securities and Exchange Commission. All of that typically runs for a typical issuance in the millions. I know when we issued common stock, we paid millions of dollars to our investment banker to help us facilitate the issuance of new common stock. In this case, for our purposes, we're not going to assume a dollar amount of the cost. We're just going to say the cost is a fraction of the issuance. So we'll say, for example, for this case, we'll assume that the flotation costs are 15% of the issuance. And that makes the calculations far easier. And so what happens now is we're going to have a new RS. And the RS that's going to come about, the formula for that RS is this. It's going to be D subscript 0, 1 plus G, D1, right? Dividend last period, grown a period, divided by the price, and we're going to take out the flotation costs and add G. So this is the only adjustment here for flotation costs. When we assume flotation costs are 0, the whole thing washes out to the formula I showed you a few minutes ago. So we're going to assume a flotation cost of 15% of the issuance. So if we issue, for every $1 million of new common stock we issue, we're going to pay $150,000 in investment banking fees. That's probably a little high, but we'll live with that number. So now our new cost of capital for issuing, oops, did you notice that? E. When we issue new common stock, it's a little subscript E, not RS. Okay, so now we got that out of the way. The dividend is $4.19 according to all this data that we had at the very beginning. Right there it is, right there. So I'm using this data here. $4.19, growth rate of 5. $50 stock price, 1 minus 0.15. So what it does is it reduces this stock price by 15%. This is really $42.50. So $42.50, when this number gets smaller, the whole cost goes up. And that's what happens. This becomes 0.154 or 15.4%. And the new weighted average cost of capital under that scenario, right? The new weighted average cost of capital will be, oops, would equal 11.94%. 11.94% versus what we had estimated a little while ago to be 11.1%. We had 11.1 without flotation costs. So it's almost 12% with flotation costs. So what that's saying again is, on average, we have a balance sheet, we have debt, we have preferred stock, we have common stock equity, balance sheet, assets. The average of all these costs, RD, RP, RS, or RE, whichever you want to use, the average of all these weighted by the target capital structure is what's used overall to discount the average project, or in other words, to discount all of these cash flows. So if you recall from the previous chapter, chapter 9, we estimated the value of the firm to be free cash flow next period divided by not K, but weighted average cost of capital minus the growth rate of free cash flow. So we valued the firm. Remember, the value of the whole firm was valuing this whole side. So we use the weighted average cost of capital here. So if we have the average project, which is what we're going to see in the next chapter, chapter 12, we're going to look at a particular project. We're going to slice out a project that we plan to invest in, say project A, and we're going to look at the risk of A, and we're going to say, you know, what should we discount the cash flows of this project by? And given that discount rate, you know, is it worthwhile for us? Is it profitable to invest in a project? Or you can think of it as a product line. Is it profitable to invest in that product line? So that's what's coming up in the next chapter. Let's see if I missed any. Oh, one more thing here. With respect to this, so the weighted average cost of capital is the discount rate for projects that are of average risk. Or, in other words, this whole side represents the average risk because it's a function of it. So if we have project A has average risk, we should use the weighted average cost of capital. Now, if we have project B and it's high risk, we should take the weighted average cost of capital and add some type of premium to it. Okay? If we have project C and it's low risk, lower than the weighted average cost of capital, we should take the weighted average cost of capital and subtract out a premium. So the point is, the weighted average cost of capital is good for a project with the same amount of risk as the rest of the firm. But if a project has a higher risk, you want to discount those cash flows at something higher than the weighted average cost of capital. So you're going to add a premium depending on the risk of that particular project. And if a project has low risk, you want to look at a weighted average cost of capital or a discount rate that's a little less because you're going to subtract out a premium. So you need to consider that with the projects. That's what's coming up in the next chapter, how to apply this weighted average cost of capital to various projects. I hung up on that guy. Okay. This was a fairly short video, so what I want to do next is I'm going to actually do a problem that's in the textbook. Problem ST2, self-test question 2, page 361, and it has to do obviously with the weighted average cost of capital. Now I'm showing you this not only because I have some time, this video is not very long, but also because I can introduce show you a slightly new concept that I haven't really talked about, and that's the break-even point with respect to retained earnings. At what point will you have to move from basically at what point are you going to have to go from RS, using retained cost of common stock for retained earnings, versus an RE when you have to issue new stock. And so at what point do you convert, do you flip from one cost to the other? That's called the break-even point. And that'll show up in the problem I'm about to do. It's best this shown with an example. Okay, so let me give you the data for ST2, page 361, your text. It's Lancaster Engineering and the company Lancaster Engineering, LEI. Okay, it tells you right off the bat it has target capital structure. The target capital structure, debt, preferred stock, and common stock. This is going to be 25%, 15%, 60%, and notice it adds up to 1 or 100%. Okay, so that's the first thing given. There's all the weights. That was easy, right? Okay, now it's giving you other information. It's saying LE's net income for the year is going to be 34,285.72. That net income number will help us determine the break-even point, as I'll show you in a little bit. The company has a payout ratio of 30%, meaning out of every dollar it earns, it pays out 30 cents in terms of dividends, which means it retains 70% or 70 cents per dollar. Okay, so payout is 30%, retention to plow money back into the company has to be at 70%. Let's see, what else is here? Tax rate. Tax rate is the federal plus state tax rate is 40%. And that's technically the tax rate you want to use. You want to look at both federal and state tax implications. Ooh, look at that. Whew. These guys are pushing it. They're saying growth is going to be 9% constant growth of dividends. And so G is 9%. It's a little high, but that's what they're telling us. The dividend just paid was $3.60, just paid for last year, and the current stock price today is at $54. Okay, and so now it's going to tell us that it can issue new stock, new preferred stock. It can be issued with a dividend of $11, DP, $11, with a price of $95. Okay, and it's telling us debt can be sold, RD, at 12%. That's basically the yield to maturity on an annual basis, of 12%. So that's what's given. And they give us a little bit more information. I'll roll that out when we get to it. The projects that we're going to potentially invest in. But here's the given data. And now what we have to do is figure out what is the weighted average cost of capital from all of this. Okay. So the weighted average cost of capital, again, weighted average cost of capital, it's 25% is in debt, is our target. It's a 12% for RD. The tax rate is 0.40, so 60% is what we're going to be, or is really what the cost will be, 60% of the 12. So really debt costs us on an after-tax basis 7.2%. Now preferred stock is going to have a weight of 15%, and RP is $11, the dividend, over the price of $95. That happens to be 11.6%. Is there. Okay, so look, so this is low, a little higher, and so RS should be a bit higher than that, right? So let's figure out RS. Let's figure out this component here. So this is 0.60 times RS. Now RS, how are we going to figure out RS? Well, RS equals, given the data, 360. You know, they didn't give us a beta or anything, so we can't use the security market line stuff. So we use what's given. 54. So we do this calculation. RS is 0.163, 16.3%. Okay, it's even higher, 16.3. So the sum of all these, let me get a little hard to read. Sum of this component for debt, preferred stock, and common stock all adds up to be 13.32%. That is our weighted average cost of capital, 13.23%. Now, before we go further, think about what that means. If we have projects with average risk and they earn a rate of return higher than 13%, 13.3%, then we want to accept those projects. We want to invest in those projects. If they earn a rate of return greater than 13.3%, invest, because we're saying that it's going to cost us to borrow all the money. It's going to cost us 13%. And if the project turns around and generates 20%, that's great, because we're going to be adding value to the firm. So that's where we're going with this now. So what I need to do is let's look at the various projects that are available according to the problem. So we have projects, and we have the cost listed, and then we have the rate of return. We have project A, B, C, D, and E listed there. The cost is $10,000 for A, $20,000 for B, C is $10,000, D is $20,000, and E is $10,000. And the return that each one of these generates: A, 17.4%, 16%, 14.2%, 13.2%, and 12% is the return. So the next question it asks, the problem asks, is which projects should LEI, this company, Lancaster Engineering, which ones should it accept? And then it says, assume that LE does not want to issue any new common stock. So we're under the assumption the company does not want to issue common stock. And so which projects should it accept? Well, let's look at the data here. Right off the bat, we can see we want to accept this project for sure, right? And we want to accept this project. This project is over to 13.32, I just calculated. This guy is weighted average cost of capital. Because it tells you here, by the way, I should tell you, I didn't say that, these are all average risk projects. Each one of these, all of these are average risk projects. And so this project, look, it earns 17%. It's costing us 13%. We're going to make this much in profit in terms of a percent here. So we're going to accept A. For the same reason, we're going to accept B. It's a little less profitable, but it's still earning more than what it's costing us. C is good, and D, ooh, look at D. D didn't cut it. Shh. E didn't make it either. They're not making high enough rates of return. And so now the question is, okay, we did that, and we have $40,000 worth of projects to invest in, right? $40,000 to invest in. Do we have enough retained earnings so that we don't push on our target capital structure? That's the question. In other words, where's our break-even point? Are we below that break-even point so that we can only use RS and not RE? Because the firm does not want to issue common stocks. So are we safe, in other words? Well, the formula for figuring out the break-even point is this. The formula is your retention ratio times your net income divided by target equity rate. That is the formula for break-even. I'll call it BE for break-even. Okay? And so we're looking at net income for a year because we're really looking at these projects. The textbook doesn't really give you a good sense of this, but we're looking at these projects on an annual basis. The company is going through these projects each year, and each year it has a list of projects that it can invest in. And so this is just one particular year. It's looking at projects A through E. So in this year we're looking at, we have to look at the retained earnings that the company has generated to see how much how much income it's generated and how much it's going to keep, because this will be used, this cash flow will be used to fund these projects. So the retention rate, it's given us, remember, 1 minus the payout ratio, we learned from another chapter, is retention. So 1 minus the retention rate of, 1 minus the, where is it here, 30% payout ratio. 1 minus 30, that's 0.70, times the net income of 285.72, divided by the target of 60% weight in equity, and we end up with $40,000 is the break-even point. So if we spend less than $40,000, we use RS. If we spend more, we're going to have to start looking at RE as the marginal cost of an additional dollar of an investment. So look what happened. How sweet the problem turns out to be is that we're right at the break-even point here. So the company's spending $40,000. It's right at the break-even point, telling us that all we have to do is calculate RS, and we don't have to concern ourselves with RE, where there's the cost of flotation costs are buried in there. Yeah, the problem didn't even give us flotation costs, so it kind of makes sense that we just use RS. So that's it, the weighted average cost of capital.